Good morning, everyone. Thank you for joining us today. So today we have several stock counter updates: Sembcorp Industries Limited, Singapore Telecommunications, Frasers Centrepoint Trust, as well as Japan Food Holdings. And for our macro and sector outlooks, we have Singapore REITs Monthly, as well as Singapore Weekly. So without further ado, we'll start things off with Singapore REITs Monthly. So just a snapshot, the FTSE REIT index is actually underperforming the Straits Times index as well as the real estate developer index. As seen in the graph on the left, the dark blue line is the FTSE REIT index. So in the last month, all subsectors registered negative price gains, except for the healthcare sector, which was up by about 1.2%. There was a pickup in acquisitions in the month of April. Several REITs announced acquisitions, as you can see at the top right hand side of the slide. So we have Ascendas, which announced its acquisition of Galaxis, the remaining 75% in Galaxis. iREIT increased their AUM by about 15.8% through a sale and leaseback deal with Decathlon for 27 retail properties in France. We have Mapletree's 1.8 billion US data center deal, which will boost their AUM by about 26.5%, as well as ESR's acquisition in Singapore, as well as stake in Australian Logistics Fund. Additionally, developers may also tap the Singapore market through REIT IPOs in the next 12 months, with Mapletree eyeing a 1 billion student housing REIT IPO, and CDL. This was announced in previous quarters that they were actually contemplating sterling denominated UK commercial REIT, and this time around they were in talks with Qatar Investment Authority to inject one more asset, which is HSBC's London headquarters, into the initial portfolio. So moving on, this is just our usual recovery by subsector. Nothing much has changed. Healthcare and industrial still in the green, above the 1st January 2020 price levels. And then hospitality, as you can see, it went back down. Now it's about negative 31.5% of 1st January's levels. Moving on to how the interest rates have moved. Okay, so if you can see the graph on the left-hand side, in the graph, the red color line is the 10-year Singapore bond yield, or SGS for short. And the SGS reached a high of 1.72% on the 2nd of April. However, it has sort of corrected downwards. It's now about 1.52%. So overall, Bloomberg consensus forecasts that the 10-year SGS will remain below 1.6% from 2021 to 2023. And this is below the 5 and 10-year historical averages. So we expect further interest rate growth to be kept in the near term. And of course, since with the interest rate being below the 5 and 10-year averages, some REITs might still be able to find accretive acquisitions. Okay, moving on to the next slide. This is the 10-year, this is the dividend yield spread. So the dividend yield spread currently is at the -1 standard deviation level. If you look at the yield spread in the graph, it is the dark blue line. So it actually hit the low of -1.9 standard deviation level. And that was because of the sudden spike in the interest rate. If you recall, I mentioned 2nd April was when the 10-year SGS actually spiked to about 1.72%. Yeah. So since then, it has corrected back to the -1 standard deviation level. So overall dividend yield for the FTSE REIT index will be about 4.26%. So we remain overweight on the REIT sector, and we think that the DPU growth will outpace the interest rate growth. So as mentioned, we think that the interest rate growth will remain around the 1.5 to 1.6% level. So of course, coming off the back of 2020, where we saw DPUs actually collapse in the wake of the pandemic, we are expecting a recovery of about 2.9% to about 48% per sector for the next for this year FY21. So, and where that compares, how the FY21 estimated DPUs compare versus the pre-pandemic levels, we can see that for Ascot and for Dasin as well as iREIT, these REITs are expected to the DPUs are expected to be below the pre-pandemic level, and of course, for Ascot is because the hospitality sector faces a longer timeline to recovery, and for Dasin and iREIT is because they are actually there have been several like corporate actions that change the share capital. So for CICT, FCT, for FCT and Manulife, Prime, Ascendus, KDC, they are expected to deliver DPUs that are above the pre-pandemic levels. Okay, moving on now to the subsector views. So, okay, starting off with the office subsector. So we noticed that there's a pickup in Singapore and US office leasing compared to the past 3 quarters where the tenants were delaying decision making. So banking tenants were the main downsizers. Most tenants have retained their previous space requirement. So REIT occupancy dipped due to non-renewals, in line with industry occupancy, which slid about 0.1 percentage points quarter on quarter to 88.1%. So on the graph on the right left-hand side, it actually depicts this sort of dip in occupancy as well as dip in rental prices. Reversions were mostly positive, mirroring a 3.3% quarter-on-quarter improvement in the rental index. So, yeah. Overall, the REITs were still able to deliver positive reversions. We see Keppel REITs reversions at about 10.4%, OUECT's reversions ranging 3.8 to 7.8%. CICT, unfortunately, they actually registered negative rental reversions, and this was largely due to renewal with a larger tenant, and that actually registered negative reversions. For the US REITs, Prime, Core, and Manulife, reversions were also positive at 9.5%, 5.7%, and 2.5% respectively. In terms of the supply condition, so while the office sector is facing somewhat of a structural decline, where we see more remote working as well as hybrid working, this is mitigated by the tight supply of office supply in Singapore. So the 5-year average supply would be about 0.7 square feet. It's below the historical 5-year average of 1 million square feet. Yeah, you can see in the graph on the left-hand side. Yeah. Okay. Now moving on to the industrial subsector. In the graph on the left, you can see that occupancy, which is the red line, continues to climb up. It improved 0.3 percentage points to 89.6%, and this is 0.7% higher, percentage points higher year on year. Industrial rents grew for the second quarter, 0.6% quarter on quarter, with improvements across the board, across all the asset classes. However, despite these positive statistics, the industrial REITs think that there will still be near-term pressure on rents. Okay, in terms of supply coming onto the market, the light industrial asset class is the most challenged. As you can see, the light blue bars here are the light industrial supply that will be coming on in the next 4 years, and that coupled with a low pre-commitment of about 17% just indicates that there will be more pressure for the light industrial sector. Yes, of course, this light industrial sector is going to be supported by the government's 10-year plan to expand Singapore's manufacturing by 50%. Data centers and high specs remain favorable. Business parks are a little bit under pressure because there has been some downsizing of office using tenants. Okay, so for warehouses, we'll continue to benefit from the higher demand from logistic players. So while there is some supply of industrial stock coming onto the market, we see the pre-commitment levels in the table at the bottom. Light industrial, as mentioned, is quite low, 17%. High spec, the pre-commitment level is about 74%. Business park, 63%. Yeah, and warehouses pre-commitment is about 27%. Moving on to the retail subsector. So the two blue lines in the graph represent the rental index. So rents continue to dip 4% quarter on quarter, and on a year-on-year basis, the rents are about 16.5% lower year-on-year. Central and fringe rents fell by about 12.9% and 16.2% year-on-year respectively. So if you recall, the fringe asset class, or rather the suburban retail malls, are the ones that have been relatively resilient. However, you see that the rents actually fell by a larger quantum, or larger percent, 16.2%. And that's because, of course, if you look in the graph on the left-hand side, the fringe rents actually started at a higher level compared to the central rents. So the retail REITs have actually reported that reversions were less negative than preceding quarters. However, we are still expecting central reversions for central malls to be in the negative low teens, and reversions for suburban malls to be in the negative single digits. Yeah. So this, of course, the negative reversions, of course, is partly due to some of the more flexible leasing terms that have been offered to the tenants that offer lower first year rents, which eventually escalate to reach back to market levels. Retail occupancy inched up by 0.3 percentage points in the first quarter to 91.5%. And overall, on a year-on-year basis, it is still lower by 0.5 percentage points. So, however, a slight positive is that the REITs outperform the market occupancy. So they have maintained occupancy levels of above 96%. So for March 2021, RSI, it actually grew by about 5.2% year on year. We see several asset classes, several trade sectors that have returned to pre-COVID levels. For example, your watches and jewelry, your telco, electronics and telecommunications. Yeah, and we see about almost 30% rebound in the fashion sales. However, that is still only at about 78% of the pre-COVID receipt levels. Overall, we are still in phase 2 heightened alert, and we expect that there will be minimal rebates provided by landlords, except in the cases of mall closure. So that presently, I think GEM is closed, as well as Westgate. So Westgate is owned by CICT, and the manager has come out to say that they will be providing rebates for the affected tenants. Overall, we expect that the kind of support that the landlords will be giving the tenants will be more will be on a smaller scale, more operational support versus outright rental rebates. So some operational support could come in the way of waiving online platform fees or extension of car park grace periods. Yeah. Okay, moving on to our last subsector, which is hospitality. So for the hospitality sector, there will be a bit of the data is a little bit skewed because if you recall last year, March, that is when COVID happened, and there was a sharp decline in the numbers. So if you look at the RevPAR, it grew by about 5.2% year on year from a low base in March 2020. RevPAR is currently still about 69%, but if you look in the graph, it is almost 40% down from 40 to 50% down from pre-pandemic levels. In terms of visitor arrivals, which is the red line, you can see that the data is a little bit skewed. We only registered about 25,700 visitors in the month of April. However, that actually represents a year-on-year improvement of about 3,000%. So that's a bit of a data skewedness here. The cancellation of the World Economic Forum, which was actually set to take place in Singapore in August of 2021, is a minor setback for the hospitality industry. This may result in a loss of confidence and reduction of corporate travelers and bookings. On the flip side, the government may actually maintain or increase the number of hotels used for quarantine purposes, and this has several of the REITs have hotels that are actually under these block booking by the government. The 6-month extension of the Singapore Rediscover voucher validity will also help provide a little bit of support for the hospitality sector, as at end April, about 83 million out of 200 million in revenues generated actually went towards the hotel bookings. Overall, we see that the major economies such as the UK and US, which are leading the way in immunization rates, and this should help propel us towards eventual herd immunity and reopening of international borders. So that's all for me, and these are our Phillip security stock calls. Okay, I'll now pass the time on to Xie Hui, who will talk to you about Frasers Centrepoint Trust.
Yeah, thanks, Nat. Okay, so we had a webinar with FCT recently, and yeah, we are just providing a brief update for those who didn't attend. We do have a buy rating for the counter. Our target price is $2.88. Next, please. Okay, so FCT, as most of you are familiar, owns a portfolio of 10 retail malls, which mainly provides essential services to domestic catchments. It's one of the top 10 largest REITs by market cap, and also is currently one of Singapore's largest suburban retail landlords after the acquisition of the ARF portfolio. For the half year ended March, DPU saw an uplift of 28% due to the completion of the acquisition. Retail occupancy still remains high at 96%, while MPI margin remains steady at 72.4%. So what's more interesting, I think, maybe what's happening on the ground due to the recent heightened alert. FCT saw a 20 to 50% drop in footfall week on week due to the lower social gathering limit of 2 people from 5 people and the tightened density limit, which reduced capacity by 20 to 30%. That said, although there's substantial impact to footfall, FCT believes that the impact on tenant sales will be less. This is due to 3 reasons. Firstly, there's a shift in consumer behavior. So there used to be a lot of pass-through traffic as FCT malls are located near MRT stations. People were passing through without spending money. Now that people are working from home, more traffic became more purposeful. Conversion rate became much higher. Secondly, with more people trapped in Singapore, people are spending more domestically. So this is evident from the previous circuit breaker, where June saw a speedy recovery in footfall from 30% in April to 60 to 70%. Sales has recovered even more sharply and are even performing above general market. So lastly, FCT has also been helping tenants that are facing difficulties through various operational supports, as Nat mentioned earlier. So FCT actually waived fees for their omni-channel platform, delivery charges for F&B tenants on their Market Master platform, as well as car park entry charges for those tenants. Although there hasn't been any news about rental rebates, FCT is looking at helping tenants on a targeted basis. Okay, so in terms of retail market demand supply, FCT mentioned that retail supply in the market is low at less than 1% for the next 1 to 2 years. Government hasn't released any new land sales. There isn't a lot of competition, a lot of new competition for the existing malls, with the exception of Pasir Ris, where there will be a new mixed development in White Sands area and also one more near Causeway Point. That said, the population at Pasir Ris may be underserved as it holds a huge residential area. People actually do flock to Tampines for retail, so the additional retail space may be able to help recapture footfall back into Pasir Ris. Causeway Point's competition is a piece of land that is reserved for a combination of office, hospitality, and 200 square feet of retail space. Right now, it's still a piece of flat land. So we don't think that we will see the competition coming through soon. In terms of acquisitions, third-party ones will be hard to come by, as there are not many malls that are sitting on top of MRTs and not controlled by property groups. Instead, they will look at opportunities to acquire more stake in 2 of their properties, North Point City and Waterway Point. North Point City is co-owned with their sponsor, while Waterway Point is co-owned by 3 parties, FCT, Far East, and Security House at 40, 40, 20% stake respectively. Far East and FCT used to hold 1/3, but Security divested some stake to them to hold 40, 40, 20 right now. So yes, these are the opportunities that they have identified for inorganic growth. This is all for the snapshot. I'll pass on my time to Terence for Sembcorp.
Yeah, thanks, Jie Hui, and good morning, everyone. Sembcorp Industries held their Investor Day event last week, detailing their transition to be a pan-Asian sustainable solutions leader. So the way they see themselves doing this is by transforming their portfolio from brown to green, with growth powered by their two main business segments, renewables and the integrated urban solutions. So we summarize, in our view, three positives from the presentation. Firstly, Sembcorp plans to have sustainable solutions form 70% of its profits by 2025. You can see this in the diagram below, this like infographic. So you can see for 2020, the renewable solutions only form 40% of their overall portfolio, overall net profit. But in 2025, the target is to increase this to 70%. So they intend to achieve this by quadrupling the overall gross installed capacity. So you can see this again on the diagram here on your right hand side. The total gross installed capacity for 2020 was 2.6 gigawatt. So for 2025, they intend to increase this to 10 gigawatts. So it's about 4 times. So the way they intend to achieve this is by increasing their capacity building in wind, solar, and also the battery storage. And more tellingly, the way they intend to increase this is all through organic growth, and JVs lah. So they will not require M&A to achieve this target. So we think this statement actually elevates any risk of any imminent fundraising to achieve this kind of growth. The next positive is the urban business land sales. They intend to triple this to 500 hectares by 2025. So we looked at their 5-year historical land sales average. It's only about 242 hectares. So this is more than double its 5-year land sales average. So we think it's quite ambitious. And in order to achieve this, they will grow its land bank to 17,500 hectares by 2025 from the 10,588 hectares in 2020. So about a 60+% jump in terms of land bank that the group will have. The last positive we think is the clearer targets that they actually announced to the group, announced for 2025. So for 2025, they intend to have achieve an ROE of 10%, which we think is achievable already. We think this is a low bar some more. And then gross debt to equity at 1.3 times by 2025. So right now, to put things in perspective, financial year 20 ROE is 3.2% and the gross debt to equity is 2.3 times. So they intend to reduce the overall capital management by 2025. So the clearer targets overall better for the group. In our next slide, we discuss our outlook and updated recommendations on Sembcorp. Sembcorp has projected overall capital expenditure of $5.5 billion for the next 5 years. This will be funded entirely by internal sources, which is the debt and equity internally. So this will drive the 30% CAGR in renewables and 10% CAGR in integrated urban solutions. They also intend to divest and recycle capital to improve debt over EBITDA to 5.4 times in 2025 from the current 6.5 times in 2020. So overall, our recommendation, we raise our target price to $2.07 from $1.77, as we now peg Sembcorp Industries to 1 times FY21 book price to book value, up from the 0.85 times previously. As we believe the detailed layout of his 5-year plan will drive a re-rating of the stock. So we think it will the fair value of SCI should be about 1 times book value. But also we also something to think note of is historically they have traded at 0.85 times ex Sembcorp Marine, of course, because they divorced from the Sembcorp Marine last year. So the price to book value is 0.85 times historically. But we think now there's this potential re-rating catalyst because now without the Sembcorp Marine Group, they can focus on just the core business, which is now the renewables energy business and the urban business. So there'll be better operating metrics for Sembcorp Industries and also better capital management. So this re-rating at 1 times, we don't view this as overly excessive, even compared to historical in terms of when we compare it to their historical average. but because most of the positives we see because of the rally in Sembcorp Industries have already been priced in, and this, even though they provided this transformation map, you can see this transformation map in this diagram below. We provided this diagram below how they intend to transform from brown to green. This is actually not new, and they've been talking about this for the last 3 to 5 years even already. So even though it's more detailed now, they put in a lot of details and detailed roadmap in terms of how to achieve it, but it's not new. So we downgrade from accumulate to neutral. Yeah, so that's all from me on Sembcorp Industries. I'll now hand over to Paul.
Oh, okay, thanks, Terence. We'll move on to Singtel's results, their second half 21 results. The title, Help from Baht and Australian Dollar, is basically a summary of what happened in the second half. I think Baht did very well, which is their Indian associate. There's a big turnaround, and also they were supported by the 9% jump in Australian dollar. Yeah, so that kind of boosted their results. Next slide. Okay, in terms of the positives for us, there weren't that many actually, but so mobile revenue in Australia was a positive for us because it was basically unchanged. What happened is that we expect it to be worse because in Australia, the prepaid segment, you get hit quite badly, when there are fewer students and fewer inbound tourism, and so that kind of hurts your prepaid revenues. But they managed to keep it stable. And also because the ARPUs, which is selling prices, actually was up, which is very unusual for a telco being able to raise prices. So that was very helpful. The other positive was in India, as mentioned earlier. So to give you a sense, I think Bharti for their India and African operations, the operating profit actually jumped 70% year on year to 541. But you notice that the profit in associate was only 54, and that's partly because they've got high finance costs. So they're still burdened with a large, like 400 million finance costs. The negatives were quite a few, but let me just highlight the main ones. In mid-May, Singtel announced a major write-down or impairment. So they had an impairment charge of Amobi and Trustwave. And then if you add in another 200 million of Amobi they did last year and Hook. So basically this is a hat trick. Hook, Amobi and Trustwave, no pun. But basically over the last 2 years, Singtel made almost 1.2 billion of write-offs for their acquisitions come digital adventure. Because most of these were acquisitions. The other negative was the final dividend. So you can see that the dividend, the red box at the bottom, the final dividend was cut 50%. And it was, for the full year, is down almost 40%. So for us, obviously, that is a negative. And sorry, just to sidetrack, if you look at the table in the middle, the red table, so this is where the weakness comes from, which is why the numbers were slightly below our estimates. So you can see that Singapore, the revenue was down, the EBITDA profitability was down 21%, because of the roaming impact. And also Australia was because of NBN. For those who can't remember, NBN, what happened in Australia was that broadband used to be, the broadband network used to be owned by Optus themselves. But the government came out with this plan, something like our Netlink Trust, so everything had to be switched over to the government kind of own infrastructure, which is called NBN. So as a result, Singtel Optus get compensated. You can see that 108 million. So they get paid 108 million because they are transferring all their customers all their customers to this new network. But on the flip side, your profitability, because the margins by owning your own network actually is better. So in terms of the outlook is, first Singtel announced a new strategic direction. So they're going to emphasize more on 5G, consumer and enterprise in Singapore and Australia. I don't think this is news. I think every telco in the world probably is going to be focusing on 5G. So I'm not sure what strategic direction there is. Anyway, the other one is that NCS will be their new engine of growth. So NCS performed reasonably well with kind of mid-teens growth. The next strategic initiative is to value unlock of infrastructure assets. One notable one is that for Optus Australia, they will probably sell some of their mobile towers or even some of the submarine cables. But for us, we are quite wary when they say this value unlocking because it's unclear whether are you disposing or are you just refinancing. I mean, just to give you an example, if you sell a factory, then you rent it back, then you say you make a big gain on your factory. I mean, is it really a value unlocking of your assets? because in the end, the value comes from how much rent you're going to pay on your factory. So that's where we are coming from. We're just a bit wary of all this value unlocking that they mentioned. So for us, we still maintain a neutral, but we lowered our target price. Our target price is a bit unusual because our target price is made, a lot of it comes from the associates. So almost 2/3 of the valuations come from associates, and this is mark to market. I mean, so Bharti share price goes up, then the thing will get affected and all come down. So that's why this is in part the reason why you see the target price comes down. So only 70 cents of the 222 actually comes from Australia and Singapore. The rest all purely comes from the associates, Telkomsel and so forth. So a lot of it depends on in a way, the share price, how the associates perform. Then for us, we are neutral because the outlook is sluggish. I don't think there's actually minimal growth in the core operations, and their dividend yield, historical about 3%. Ours is a forecasted yield, so 3.7. So it's nothing exciting about the yield, and the outlook is still sluggish. So that's why we're sticking to a neutral for Singtel. Next slide. Okay, we go on to our weekly. Next slide. Anyway, for Singapore, not really much of a macro data. I think we had our GDP. I won't talk about that. But we announced the enhanced GSS is mainly to support the 50% salary support for the F&B, gyms, etc., and all those retailers that are affected. In terms of news from US, I think what caught my eye was mainly the core PCE inflation. Core PCE is important because this is basically inflation that the Federal Reserve uses as a gauge to see, because there's also CPI, but they use PCE because of the different rates. But so what happened is in April, the most latest reading last week, the CPI actually was up 3%. So this is way above their 2% target, and last year was last month was 1.9. Of course, right now the Fed is just saying that you don't have to worry about inflation now. It's base effect. So base effect means last year March it was very, because of the pandemic thing, the inflation was very low. So when you compare year on year, it's weak. But you will start. But this base effect will start to wear off in the third quarter. And if third quarter inflation remains high, then maybe the Fed will have to tighten earlier than expected. So it's not a prediction, but it's just something to be wary and something to watch. That interest rates might kind of accelerate faster than expected. The other news we got all over is the Biden 6 trillion budget. But I think from our viewpoint, at least, the more important thing was that to fund this budget spending of 6 trillion over the next few years is mainly tax hike. So I think Biden is proposing, I think you can read from them, corporate tax, they want to raise it from 21 to 28 in the US, and also higher capital gains tax. This is the highest bracket, of course, from 23.8 to 43. So I guess for us, we are more mindful of that, just that if this really gets implemented, of course, it's going to be negative for the US corporates. But all these are still wish lists and still needs to get passed by the Congress. We'll touch later on Japan Foods. The reason we're interested is just that we just want to see how is a typical F&B operator coping with the whole situation. We'll touch on it later. In terms of our tactical views, we are cautious. I think we worried, as we know, there could be on later today, there'll be the ministerial task force and also PM address. So we're just worried that there could be further tightening of the COVID-19 restrictions and no further tightening, of course, they mentioned, but there'll be a risk of an extension. So that's why we're a bit more worried. And also, there's an endemic scenario being planned. So this means a constant testing and also came out in the newspaper that the PCR test utilization has doubled from 40 to 80%. So why we are just highlighting this is because, Q&M is probably the only one, apart from, I think Raffles Medical also will do some of these PCR tests, but of course Raffles Medical will also do vaccination. PCR test utilization. So this will be a big boost for Q&M. I mean, if they actually, as they are increasing their utilization. In terms of the events for us, for this week, we will have Keppel tomorrow, and then Cromwell, and then and also Seatrunk. So if those who have time, I mean, feel free to just to register. It's open for everyone. The rest of the events is at the bottom, and some of them are in province for you to register. Next slide. Okay, our usual tracking of pandemic, despite the situation here and in Asia, I think globally the numbers are coming down and they are shrinking like 30% month on month. The WHO mentioned, the next bullet point the WHO mentioned 70% as a herd immunity, so-called. So we did our own numbers. I think you can get it from our work in data kind of stats. So if you kind of look at the numbers and extrapolate the kind of vaccination that's happening now, the whole world will probably get vaccinated only in maybe 2024. I mean, if you kind of extrapolate the numbers. Again, these are all mini statistics. Could be faster, could be earlier, but right now the run rate is on only the next 2 to 3 years only can the whole world get vaccinated. I mean, just like something that we can't calculate. Next slide. Okay, in terms of the one on the left, of course, is Malaysia. The yellow line, that's the worrying thing. You can see that right now the average is 7,000, but the most recent numbers is as high as 9,000 plus. Why Malaysia is important, of course, apart from being our trading partner, closest trading partner, is also we have a few listed companies with Malaysian operations. I did speak to 1 or 2 of them. So just to give you a sense how this thing works, the lockdown for factories. Sorry, it's not a bit more detailed, but assuming a factory has no morning, afternoon, and night shift, assuming you have 300 workers per shift, then right now you can only have like 60%. So you can only have like 180. So every shift you can have only 60% of your typical number of workers that you have. So one way, so this will have some short-term impact on the factories that are operating electronics, even the glove makers. But one way they can get around it, not get around it, but maybe they can extend it, maybe working from 6 days to maybe work to 7 days. So that's one way to maybe kind of extend your ability to raise your utilization. But there will be some impact. It will be for 2 weeks for now. But of course, the risk is this thing get extended to 3 weeks, 4 weeks. I mean, we do not know. The other worrying thing as a side note is also, Malaysia is also a big electronics manufacturer. So it will also kind of make the whole component shortage situation worse. So in the electronics industry now, there's a huge capacity constraint, shortage of components. Almost every component is in shortage. And with all these lockdowns from Taiwan to Malaysia to Japan, all this will affect. So this, you see this chart, like Japan, all that, there is some quite a big impact on the whole supply chain. Sorry, I totally side note on this, but I mean just for everyone's info, like you're interested. The next one is just on Europe, so they are doing well. Next slide. Okay, for Singapore, it is still stubbornly high. So we are still like 19 cases a day. I think for me is that whether or not they will extend, before they started the phase 2 HA, I think we were running at about 28 a day. And then right now it's about 19. So not much of a change or the big decline, considering when we were in phase 2, we had 7 phase. As you can see the chart on the left, in 2nd June, 19 June, the cases were 5 or 7. So right now at 19, I'm not sure if they're going to release. So my own guess is they're probably going to extend the current COVID-19 restrictions, because the thing isn't dropped to, if it's dropped to 5 to 7, then maybe there's a chance for them to just end it. But I think between 19 there's not much of a meaningful drop yet. I think this is my own guess based on the numbers. Next slide. Okay, so for this one, why this chart is important, the red line is basically what is the Fed's inflation target, just to put it in very simple terms. So you can see now that the inflation numbers, the line in blue, is way above what the Fed is targeting. But so far, the Fed has said that you look at the second bullet point, they really expected this, number one, and they expect this to be temporary. But like we earlier mentioned, this temporary can only last for the next few months. But if you go into the 3rd quarter, 4th quarter, inflation is still running at 3%, 2.5 to 3, then my worry is that they have to start tightening faster than everyone thought in terms of 2023, you need to start to raise rates. So that could kind of speed track the whole situation. But anyway, this is a guess for now. Next slide. Okay, anyway, we run to just the last slide, just Phillip on the ground. So we had a briefing with Japan Foods, and as usual, I know not everyone gets access to these briefings, so we just wanted to share some of the key things. And also more important is, we're just curious, I mean, they are a F&B operator, one of the largest on Japanese restaurants, and we just wanted to kind of understand how are they faring in this situation. So right now, Japan Foods actually, they run the Ajisen and a few that you can see the names there. So the profit was 3.6 million in FY21. Of course, it was a big jump, like from 1 million last year. But worth noting that almost they enjoyed like 10.5 million of government grants and rental concessions. So you can, from this you can see that if not for these government grants, this company would have been quite in deep losses, number one. And if you look at the net cash, about 23 million, so you can see in a way like half of their net cash came from government grants and rental. So again, without government grants, you can see their balance sheet also will be kind of like, it will be quite problematic. I mean, their net cash will shrink dramatically to only 10 million. But the interesting thing is they are paying out all the 3 million profits as dividends. So it means up to you how to read it. Is it profit they're paying, or is it government grants and rental concessions that they're paying? But again, this is just for everyone's interpretation. The second bullet point, so what is happening from there right now is they have to close 9 shops. So you can see the chart on the right, and these are permanently closed. The rationale of closing is just to de-risk. I think because of the unknowns, right? They can't afford to kind of keep the current stores, and they just don't need to de-risk the portfolio. So that's why they close. And I'm not sure if there could be more closures, because they have to wait until the rental contracts end before they close, because otherwise they have to pay penalties. So you won't know the effect until the rental is due. The other thing is on delivery. So to them, all delivery platforms charge the same. They do use the more platforms like Capital Eats, and mainly because they have customers there that want to use points. So, and also they just want to use on all delivery platforms. I mean, they do not want to lose any pool of customers, so they just tap on everything, on all delivery platforms available in a way. Okay, the big one is of course rental. Everybody wants to know. A lot of it is they can't. A lot of NDA, so they can't. For the situation right now, any rental rebate will be discretion of the landlord. But for them, they're good position because they've got so many stores, and also because of the strength and size, they will fare better than other F&B retailers. In terms of the outlook for rental negotiations, they can't disclose, but for them, they expect highest to be flat and maximum down 10. So they do not expect rents to increase at all. The maximum decline is 10% for them, they think. I think this one we know, CBD in Orchard is the worst, and they did not even fully recover even before the current kind of lockdowns that we had. Compared to circuit breaker, they are performing better. I think right now they are more prepared for takeaways. So to give you some sense, right in the current phase of 2HA, they closed 8 stores, but during circuit breaker, they closed 45. So they are a bit more prepared, and the situation not as bad as circuit breaker, because right now they are more prepared for deliveries. Okay, I think that's the end of it. I mean, again, this company is small. It's not a recommendation, but just to give everyone a sense of what's happening on the retail scene. Okay, I think we can move on to. Okay, let me just take this Balset before the rest. Can you all just do the rest? Okay, and for Balset, what happened was they had a pool of industrial properties, so they sold it and they made a 200 million gain, or 100 over million gain and 200 million proceeds. So from a net cash of 160 plus million, they swung to a net cash of 400 million right now. So it's a huge windfall for them. So right now they are trading like 80% net cash. So that's why I think the share price beginning of the year, it was probably trading at net cash, because beginning of the year, they were like maybe 80 cents. That means their market cap is about 400 million. Right now, their cash is 470 million. So I think that's why the share price did so well, because of this big disposal. So right now, the core business is worth about maybe 100 million. And again, this is hard to guess, but the other operations, maybe they're making 30, 40 million or more. So they're probably trading at 2-3 times PE. Again, we don't cover it, but I guess having 80% market cap cash is great. And it was all because of the disposal of, I think, 11 properties that they did into a fund that they created, and they get this really huge windfall. I think that's the best we can do, because there's not much briefing and we don't really touch base on the company. So we hope we hope that is helpful. let me just run through the next one. What is Singtel's growth engine for NCS? NCS, because NCS is growing well, and of course we have to bear in mind that most of their customers come from the public sector, and I think we all know who that is. So, and because the public sector is spending a lot on cloud solutions, security, and so forth. So that's why that is their growth engine. So I think they're going to announce some details the next few weeks. I think they did mention that. Maybe a listing is possible. We do not know, but I think that's what we mean by growth engine, because maybe the rest are not growing, so that's the only growth engine. I guess another way to interpret it. I hope that kind of answers the question. So if you look at the results, the one that's doing the best is actually NCS. I think mid-teens kind of growth. The rest are all flat or down. Okay, thanks. I think we can move on to the next.
Hi, okay, I'll take the question on Singapore REITs. Please touch on Ascendas, Frasers, Escort, and CICT. Okay, so for Ascendas, we start off with Ascendas. So Ascendas is industrial REIT, as most of you know. The most recent acquisitions that they have announced, of course, would be the Galaxy's 75% stake, as well as their UK or US data center portfolio. Yeah. Okay. Overall, I think their occupancy has been quite stable. The occupancy for Singapore fell slightly by, I think, 0.5 percentage points quarter on quarter. It has been declining quarter on quarter, but for the rest of their overseas portfolio, it has been relatively stable. Okay. Overall, I think Ascendas is still in a good position to continue acquiring, but they might slow a little bit because of their major acquisitions they have announced recently. For Frasers and CICT, I'll take them together. So as we know, Frasers, they are retail operator, retail landlord, and CICT, they have both retail suburban central malls as well as office portfolio. So for the retail sector, as you know, rents are still they have declined in the first quarter. I think they are at a point where they are stabilizing, or they might maintain the negative 5% mid single digit kind of reversions. Overall, the heightened alert, phase 2 heightened alert, I think will sort of damper the sales in general, your discretionary sales, and even though there might be a little bit of uplift coming from the food operators or your F&B. For Escort, the fluid situation in terms of the second wave and your new variants of the virus, that one will definitely cause some near-term share price volatility. Of course, amongst all the hospitality counters, we think that Escort will be the one to recover the fastest, and or rather, recover the fastest because of their large exposure to countries with large domestic markets such as Australia, US, and in comparison to some of the hospitality counters, such as the very Singapore-focused ones. Yeah. So that's all for me.
Hello, good morning, everyone. Vivian here. I can't seem to on my video, but anyway, so there's a question on Fortress Minerals. The attendee is asking about the business and financial updates. So as we all know, so Malaysia reported this total nationwide lockdown for all social and economic sectors. So Paul has touched on the new restrictions, but anyway, before this lockdown, this nationwide lockdown for all social and economic sectors, the operations were still continuing as per normal. And last Friday, I think the management shared that they are still awaiting instructions from the Department of Mines whether they can continue their operations. But anyway, maybe a bit more color to backtrack. Last year when the pandemic resulted or disrupted their operations. So last year from 18 March to 29 April, they actually had to stop their operations due to the restrictions. So the volume recorded for that quarter, which was affected, so first quarter of FY21, which is March to May 2021, was 75,000 dry metric tons. And for the rest of the quarters, it was much higher, also partly due to Fortress ramping up their productions. So in 4Q, it went up to, I think, 150K, so it was about double that. So given that said, if going forward, Malaysia manages to, control these numbers from hitting new targets, we could expect that they are able to hit our production targets, which is a 10% increase year on year for FY22 as compared to FY21. But as we all saw from Paul's graph, that the numbers are much higher than before. So we don't have any. We are not able to comment on that, like going forward, whether they can still hit the production targets. But over the next week, I think we will get more information on that, whether the approval that they are seeking from the Department of Mines is approved. Yeah. So and lastly, it would be that the target price is still under review. Yep. So that's all for me for Fortress Minerals. Thank you.
Okay, I'll take the question on the SIA MCBs. So the question is, can you comment on SIA's mandatory convertible bond issuance and impact on existing shareholders? So the 6.2 billion worth of MCBs will not really have much of an impact on the shareholders in the short term. So the theoretical rights price is about $4.79. So it's quite close to where the share price is right now. So it won't really dilute anything. The reason is because the share this mandatory convertible bonds will only be converted at maturity, which is 9 years later, unless SIA wants to redeem it earlier. But the maturity date is 9 years later, so there'll be no dilution to the number of shares for SIA until further down in the future. So that's why right now SIA will only receive the cash first, then the dilution will come only later on. So short-term wise, not really much impact on existing shareholders.
I guess I'll go next before Paul comes in. So I'll just do some of the screen sharing. Okay, so got quite a bit of what's it called? A bit of counter. So I'll go through Sheng Siong and then list of counter here. So I noticed that there are a lot. So bear with me, I can't cover everything today. So I just cover as much as I can. So for Sheng Siong, if you look, we have this flag-like pattern falling wedge at the multi-area important support zone. So hence, if it breaks up on the upside, and furthermore, if it breaks 1.65, then we can confirm the upside to 1.80 and beyond. All right, long-term target resistance at 1.82 for Sheng Siong. All right, so that's all. That's a very simple analysis for Sheng Siong. One thing to note I still maintain my long-term view at 1.32 to 1.38. If this bullish flag or this small little rising wedge is fallen. Okay. All right. So next one is someone asked about Wilmar. So Wilmar, I foresee some more downtrend going on still, especially after today's bearish candle that broke below the little panel. So I'm looking at the next support zone over here at the 4.27 to 4.44 region. Hence, this will be the best rebound. All right. Prices didn't fail to hit $6. So hence, I think there will be one more downturn to form a wave of the sub move. All right. So this my view on Wilmar. So the next one is BYD. BYD, as I mentioned last week, we do have an upside, and then this why is because of the V-shaped recovery. But I expect some sort of continuation downturn to form an inverted head and shoulder. All right. But longer term outlook remain range bound at best, and then hence still not very confident of their upside. Despite Sembcorp spending moving up. We need to look for a bullish Kumo freeze so that we can go on the upside. But the upside will remain very sub-corrective move. So the hence, I think BYD is going through a very long-term range bound. So you're going to plot out the whole thing. It will be some sort like a flag, a larger flag in response to this. So hence, I'm not very confident of a continuation upside on BYD. Same thing for SMIC. SMIC, think last week the last Friday, bearish dark cloud cover, and then there's an inside bar today. So price may face further downside pressure to reach support zone at 16.75 to 17.75 region. But to take note that there may be a surprise upside if price do break 25.15. Reason is because this rising wedge in response to this three-wave up move. So whether it will make another sub three-wave up move, it depends on the on whether can we break immediate 25.15 region. Long-term resistance remain at $32, psychological resistance. Highly chance that this $32 is going to have another fall. All right. This whole thing is much more of a range right now, range counter right now. If 32 is being broken in the long run, then we can see 41.60 in the next longer time period, mid time period, as this is enlarging three-wave, sub-three-wave pattern in the wave theory. So we shall see how it's going to perform, right? So next one is Capital DC REIT. So Capital DC REIT had a weak rebound. Closes my first target price, and then price came down to a selling call. So what my worry is, this may be a corrective pattern in response to this impulse down wave. So we might face a stop out in lieu of my recent buy call on Capital DC REIT. So long-term support remain at 2.21 to 2.28 before we ever edge out to $3.20 target price. Okay. So Capital Corp remains in my playlist. So prices today has a sell down after a weak closure on last Friday. This is a bearish candle. So if it's first face a further sell off, it'll be an evening star pattern. So hence it will be more like a correction before rebound up to the resistance zone, and then followed by a major support at 5.10 to 5.17 in the longer run. So $6.10 will be likely my target price as well. All right, this resistance at 5.93 to $6. All right, it may go as high as $6.10 as well for Capital Corp. Reason is because I think if I do measure this pennant-like symmetrical triangle. It is at $6.11. All right, 1.32 region. All right. So the next one is Top Glove. I think Top Glove, many people are concerned. I would say that Top Glove maintain a neutral. It fails to meet my target of by a difference of 0.1 cents, 0.01. And hence it has sold down. So long-term support, if you read my report, is still mainly at $1.33 to $1.09 for that. Okay. So I know some of you asked about the banks. What's the trend going on? I would say that for the banks, especially OCBC, DBS, I think banking trends are still upside on a very strong note. But you can see there's some sort of exhaustion here because of this divergence. So hence, I believe that there will be some sort of like a correction to this level. Okay, so sorry. There's some sort of like bearish candle. So if this bearish candle end up in a bearish Marubozu, it will be 26.71 to 27.33 support zone. Okay. All right. So yeah. Okay. So this is what I have for the banks. Which later on I'll go through the SDI as well. Okay, so next one will be StarHub. StarHub longer trend is still on a very strong downtrend. All right, despite I think recently it's just going on to the range. Hence, I don't think the price movement for StarHub will move that much. All right, so upside remains capped at $1.30 psychological resistance. So hence, we will not be looking at StarHub that much. All right. Jardine Cycle and Carriage. First thing, I think the ascending triangle is still well. I think the ascending triangle has been broken, so we are looking at one more wave, true wave down formation. So hence, I think the major rebound will be at this support, long-term support at 19.69 to $20. Okay, so because of this like rising wedge, which is in response to this impulse down move, we're looking at this support at 16.69 to $20. All right. Ascender Street, so far none. All I can say is very ranging. It's in a very large triangle. Last week, I mean the last two webinars I've been talking about the inverted and shoulder, but I would say that it is likely to fail because there's two successive measuring gap, breakaway gap, sorry. And then hence, if you look at that, this is like a pennant. So I expect that price is going to go up higher before it goes down to $2.70. Okay. So I believe that there is much more of a downside, especially this one is a three-wave down followed by a corrective rectangle followed by another downside. All right. Okay, so for Mapletree, good news is the resistance level has been tested multiple times. You can look across the board. If this bullish candle maintained today, so we have a higher chance of it breaking higher. But the next threat of $3 psychological resistance still poses a challenge. So hence, I would say that the next, if it breaks 2.80 to 2.84 resistance level zone, then we can see that the $3 will be likely the next target as well. Okay. ISDN, first of all, ISDN, I think prices has been moving according to plans. We're looking at a long-term correction down. So we have a first three-wave move completed. So the next three-wave move will be this 1, 2, 3. All right, and then followed by one more down move to the support zone at 0.415 to 0.445 before a rebound If this materialized, then we can see a larger bullish flag in response to this potential upward move. If we translate into the in the weekly chart, then we can see that we are seeing a strong bullish wave up on the upside. Okay, especially this end wave, right? Will be like it's like what do you call it? Three successive moves, and then 1, 2, and then 1, 2, 3. So this one will be the next three wave movement down. All right. Next one, First Resources. Highly possible that it's going to face some more downturn, especially if it has really broken out of the channel. All right. So unless it close above 1.55, otherwise I think that this one, any upside will be in response to a correction, and then will move down lower to the support zone at 0.99 to 1.10. Hong Leong Finance, larger trend on the weekly chart remains down, okay, despite recent up moves. So especially dark cloud cover has been materialized. Hence, I think the next support at 0.92, 0.94 will proven to be a better support zone. Okay, so hence, if this play out, let's look at if we can have a pennant-like pattern like this. Before we can go up, before we can anticipate a bullish rebound move. Next one, bull state. Bull state is I think a bit dangerous. First of all, it breaks a new high, but I'll still wait for retracement back to a support at 1.10 to 1.13. All right. Reason being, I think the first half of the day it shows a very bearish signal. So unless prices push back after lunch to form a bullish candle, then there will be a successive bullish up move. But otherwise, I think this one might be the take profit for majority of traders. That's why there's a lack of supply and demand, lack of demand. So prices is maybe looking back to equilibrium at 1.10 to 1.13. SunPower wise, same thing. Price may face additional upside before pulling back, rebound at 0.885 to 0.9 before rebound to the upside. All right, panel wise is still forming. Okay. Jaffa, I'm still strongly bullish on it, but I expect some form of like a pullback back to a deep pullback to 0.810 to 0.835 before rebound to the upside. Okay. And then PropNex has been going high. Expect some sort of like this one may be a reversal formation, and then price may form a minor true wave correction down to 1.09 before rebound to the upside. Okay. APAC Realty face the same issue with PropNex, I think, but the difference is I think PropNex has reached all-time high, but APAC Realty has not. And then first of all, this bearish gap zone is looking to fill. So hence, believe that the gap zone might be filling, and then it acts as a resistance zone. Hence, I think there's a possible that you follow like what PropNex is doing through way down before a rebound. All right. Lastly, I think we are concerned about the STI index, our local index. So our local index, as noted, like last week, I think I mentioned, I think 2 webinars ago, I foresee 3190 to 3240 to be facing some sort of correction. But how deep it can go, I'm not sure. Preferably, I think if we are able to stay supported at 3019 to 3057, we are safe. All right. Otherwise, we may face deeper correction to 28 to 2908. Okay. So if this one is broken, we might face a deeper correction back to here. And then, which I think that highly, if we look at the wave chart, the true wave correction pattern, 1, 2, and 3, we are highly possible that we will be facing at 2009 region. All right, that's all. So I'm done with my technical. So pass my time back to my colleague. Thank you.
Yeah, thanks. Thanks, Viren. I will move on to, I got locked off earlier, sorry. I'll try and move on to some of there are quite a bit of electronic questions. Sorry, I can't turn on my video. The questions on AEM and EMs. Let me just give you a rough, since there's so many questions on electronic, let me just give you a rough sense of what's going on. So right now, for all the EMS players in general, they're facing like two challenges, of course. Be it a venture or even Valuetronic and so forth. So the first one is, of course, all this is the component shortage. So component shortage is getting worse every month, and even some components you can't even buy it. So that is hurting a lot of the schedule and ability to produce goods. I mean, that's obvious, and it's across all the products. Semiconductor, from ICs to MLCCs, yeah. So it's across the board, and even LCDs, there are all kinds of shortages. So it's negative across the board for a lot of electronic manufacturers. So for UMS, we still, if I had to prefer, I think although we don't cover, I think UMS, why, I mean, from the top down, UMS looks still resilient is because, you know, their main customers are Applied Materials, and Applied Materials has guided very positively for the rest of the year. So I think UMS will do well, and logically, because they are on the front end, because everyone is trying to beef up capacity and build up new factories, so they are doing the machines for these factories, so they will be the beneficial. I'm saying very layman terms, so they will do well. And the most recent number for UMS, they make like 15 million. So as you, I mean, again, I don't have a forecast. You assume 60 million. Their market cap was 700, so they're probably trading about 11 times. I wouldn't think that it's like ultra expensive, because the question was whether it's expensive. For Franken, I don't really cover, so I can't really comment. For AEM, you know, in year 2000, AEM was guiding. When things are positive, they were guiding on their revenue from 300. Then they announced again a few months later 400 guidance. Then announced 500. Then for this year, they said they cannot make any guidance because they're going to take over for CEI. I'm not sure what's the logic of it. Anyway, I think for AEM, my own guess is that they're probably having a lull now, because they are selling a lot to Intel equipment, and then Intel takes some time to build up their new factories. So probably AEM might rebound, maybe more of a next year story. Again, this is all my guess. We don't really cover them. For me, for electronics, I thought Aztec Global would be a bit more interesting, because again, we don't have recommendations. We just want to qualify, but because they already announced they got very strong order books, number one. And number two, for me, what was impressive for Aztec Global is the Amazon. And if you know Amazon, I mean, if you are, Amazon is selling everything. I mean, they're probably the biggest, for batteries, those simple batteries, they're probably the biggest battery seller in the world right now. And because of their platform, so Amazon knows what are the best products being sold. They know what are the best price points being sold. And if they want to, I guess they can kind of prioritize their products. So if you have a customer like Amazon, I think it's a very strong growth story, because Amazon can basically tell you what is the most popular product, what is the best price point to sell, because they got all the information. Right? I mean, we have to be a bit realistic about it. I mean, Amazon can kind of use all the information they want to, and if you are selling to Amazon, so that's why for me, I think my own view, I think Aztec Global looks interesting because of the Amazon factor, because everything gets kind of Amazonized. Yeah. I hope that answers it, because we don't really cover quite a lot. All these companies, UMS, AEM, I don't cover. So I'm just trying to give you some sense of what is happening, my own view. Yeah. Okay, then what's your view on MM2 and Thomson? MM2 just announced 100 million loss. We try and give you more details later, because they're going to do a briefing for the analysts on Thursday. So after that, as usual, we will try to brief you what are the key points. So probably we can help you better there. For Thomson Medical, we don't cover, but I think Thomson Medical, the difference for them is they are still building new hospitals in Malaysia. probably not the best idea right now. So I think probably Thomson Medical, and if look at the most recent first half numbers, they make 9 million, 8 million of it is from other income, which is government grants. So they are still barely breaking even. So I think my own view, we never met them, they don't do briefings, is that it will still be challenging for them because you have this added issue of Malaysia there because they are still building new hospitals, and new hospital, you're lucky you break even you will break even after 2 years, but theirs is partly extension. But again, these are just our general thoughts. So it might be a bit challenging for Thomson Medical. Yeah, I hope that helps. I think if the rest can kind of help answer if there's any others. Thanks, everyone. Okay, this one, Paul, how do you compare Japan food to Kimli and Kofu? I think Terence can add, but if I have to put if I have to bet on one, I don't really. I think Kimli, like Terence mentioned, has quite okay, for Japan food. The issue for Japanese food is there's a lot of competition. I think when you started, there were one ramen store in 5 malls. I'm just exaggerating, but I think right now there's a lot of Japanese concepts up there, and I think the competition is the factor to worry about for Japan food because there's so many Japanese competitors right now compared to maybe 10 years ago when it all started, or 20 years ago when it all started. For Kimli versus Kofu, I think I'll leave it to Terence, but I think for Kimli, they got the advantage is they have a HDB footprint. But anyway, Terence, you might want to help out on this.
Yeah, sure, Paul. Sorry, I can't. There seems to be a problem, like showing the video today. So that's pardon me, and there won't be any video now. But how to compare Kimli and Kofu? So for maybe a little bit of background on Kimli first for those who don't really follow this counter. The similarity between Kimli and Kofu is that they both operate food courts and coffee shops. So the key difference is that for Kimli, their geographical focus is the geographical concentration is only in Singapore, whereas Kofu has a geographical concentration in Macau. So about 30% of their revenue for Kofu comes from Macau, the normalized revenue lah. Whereas Kimli is just pure Singapore. Then the other difference between Kimli and Kofu is that for Kimli, most of their outlets are in the industrial canteens, industrial areas, and also in the heartland areas. So relative to Kofu, whereas Kofu they have food outlets at the educational institutions and also in Marina Bay Sands and also the office downtown areas, which during good times you get a better uplift, but during the COVID period, then they're hardest hit because of their most of their operations are in the downtown areas. So if we were to compare Kimli and Kofu, and then of course Paul has provided you a background of Japan food, then we will say Kimli is a little bit more resilient now because of the location in which their outlets are in, and also because of the geographical location in which the outlets are in. So this is a very brief answer, but let us know if we answer your question. If we didn't, then just put it in the comments. We'll elaborate also. Thank you.
Okay, hello. Let me take on the question regarding iron ore again. So the question is iron ore futures still supporting the price of Fortress, and what is your longer term view of the iron ore demand? So if we look at the iron ore, the futures graph that you can see, actually the trend is quite similar to the trend of the stock price of Fortress Minerals. So it has already gone down to below 200. Yeah, so as I said, the trend is quite similar to Fortress Minerals. So you can use this graph as like kind of like a guidance for the iron ore players like Fortress Minerals and also Southern Alliance. Then for the view of the iron ore demand, I think at least for the midterm, demand is likely to stay because with your major economies still expanding like China and possibly US, there is still, because iron ore is the primary raw material for steel making, and with building, the construction of buildings or cars, or like buses, anything, a lot of things, they need the steel. So the demand will likely stay. And on the supply side, like other major miners like Vale from Brazil, they also mentioned that they are ramping up their production. So it would possibly be that the gap between the supply and the demand could narrow slightly, but yeah, demand is would stay for at least the medium term, I would say. Yeah. Thank you. If you need any further clarification, please let me know in the comments. Yeah, thank you.
Hi, I'll take some questions. One of the questions is, which is the best performing REIT right now? I'm going to answer it from like a share price performance point of view. So in terms of share price performance, we see that most of the logistics focused, or rather warehouse logistics focused kind of industrial REITs are the ones that are doing better. Apart from that, also Sesio. So I think Sesio REIT is China focused retail REIT, and they hold a lot of these outlet malls. And the outlet malls, of course, they have some luxury brands that are located within these outlet malls, where, as we know, China, they love their luxury products. So while the borders are closed, I think the domestic spending has actually helped Sesio. Yeah. So apart from that, I think we still think that the industrials will be the ones that are resilient, yeah, and most likely the ones that will continue acquiring and growing via inorganic growth. Yeah. Other questions that have come in. What is the Ascenders REIT NAV after acquisition? So pro forma NAV post acquisition would be about $2.23. Yeah. And that, of course, represents a 1% NAV accretion from 2.21. Another question, Capital DC REITs, fundamental recommendation still hold. What is the view on TA? So I believe our call on Capital DC is actually a buy. So we have maintained that buy call. Also part of our target price actually comes from us forecasting an acquisition of about 500 million. Yeah. So our target price currently, of course, is $3.20, and that assumes a 500 million acquisition that will come in the fourth quarter of 2021. So as for Capital DC, we know that Singapore is still maintaining their pause on data center supply. So in the next 1 to 2 years, we expect to see the rentals being rents being pushed upwards, and that actually coincides nicely with a lot of the lease expiries that for the Singapore assets. So Singapore actually contributes about 75% of Capital DC's revenue, and so that, of course, is a positive. In terms of acquisition, it seems that the cap rates have compressed. They have compressed about 50 to 75 basis points year on year. So it just means that it will be a bit more. It takes out a bit of the accretion from acquisitions, given that the valuations are now higher. I think Malaysia, which is just our neighbor, there have been several hyperscalers that are actually moving to or managed to secure permits to have data centers in Malaysia. So that might be a market that Capital DC can explore in the near term. Okay, that's all for me.
Maybe I'll take a few more technical questions before I think we close off for the day. Okay, so I'll start with top left. So Top Glove, like what I shared about on not Top Glove, UG Healthcare, like Top Glove, I think they move hand in hand in tandem, and especially I think the resistance level over here, right, has been been rejected twice, forming a double bottom, a double top, sorry. So hence, I think this level is most likely being invalidated. First of all, you look closer, this is like a consolidation, a corrective in response to this downside move. So hence,
Sorry, Weiren, your diagram is still on iron ore futures.
okay, so sorry. Okay, so yeah, okay, for UG Healthcare, so resistance zone has been rejected twice, a double top at 0.750. So hence, I think we will be looking for further downside. And I think I've been mentioning that the wave Z is still ongoing. All right, so it'll be a triple zigzag corrective pattern forming, and then hence we'll be looking at a further downside some more. All right, for UG Healthcare is likewise like Top Glove. All right, next one is iFast. iFast has broken up the $7, 6.68 resistance level. It totally caught me unaware. So hence, I think this is an impulse move. Any downside we are looking at is looking at 7.73 to 7.40 support zone before rebound to upside to close above $9. And then I think $10 is highly possible as well. All right. Pan United, next one. Pan United has a very deep correction after a steady rise from 0.3 to 0.350, so a growth of like 5 cents. But I think that this upside move is likely to cap. It need to survive the test of 0.320 to 0.330 going forward. All right. So Pan United, longer trend is still on the downtrend. All right. So hence, any upsides still need to clear above 0.380 as well. Next one, Broadway. Broadway, I think ever since it breaks above 0.146, we are targeting 0.160 for the first one, and then 0.171 for the next target price as well. Price has been steadily like making like this one is an inverted head and shoulder. Price has been making a steady upside, so this one will be a much more impulse build up. So hence, I'm confident that Broadway will reach 0.160 as a target for the next target price. All right. I think. Wait, let me see. Is there any like AEM? Okay, so I'll go AEM, and then after that, I'll pass the time back to Paul or my colleague to close our session. Okay, so our price actually is making a resistance resistance zone. So there's some sort of like a rejection. So plus the fact that this up move is very strong. So and furthermore, right, if we break resistance zone 1, resistance zone 2 is likely to be rejected as well. Okay, so I think for AEM, yep. This one I will just stay put for now. All right. For Capital DC, I've someone mentioned Capital DC. Previously I've mentioned already. So due to time constraint, I won't repeat Capital DC again. All right. So that's all for my technical part. Pass on my time to Paul to see if there's any more questions that he would like to answer before closing off. Thank you.
Yeah, I think in view of time, because Weiren has a 1 p.m. For US market technical, so I think we will end it now. Thanks everyone for your time, and again, if you have time for if you have time for any of our LISCO webinars, now just go into the Powens website under education. It's open for everyone. You can just self-register yourself there. And so thank you everybody for your time, and we hope to see you again next week. So thank you everyone, and take care, and bye bye.